We are continuing the trend of large cap companies. And in fact, today we're looking at the company with the largest market cap in the world, and that's Apple, ticker AAPL, the smartphone computer technology company. And right off the bat, let's look at the smartphone market, since that's probably what they're most known for. And Samsung is the king. Year after year, they're pulling in the majority of the market. And then we have Apple here, 15 to 18%. Almost a third of the market is on just another smartphone manufacturer. Actually, Google is about 3% of this, and that's something that I didn't mention the other day in the Google video, where they are making incredible smartphones. They just unveiled their Pixel 8 today, and it is insane. They're probably going to be gaining the most market share out of any of these companies here, and I think they're going to be a massive threat to any of the companies on this list. Right now, there's the Google versus Microsoft court case going on because Apple was taking money from Google to make them the primary search engine on their devices, and it's probably not going to turn out pretty for Apple in this case. They're probably going to be losing a few $1 billion a year because it sounds like that is going to be frowned upon highly. But when we're looking at the company, we're coming up with a fair value around 130, current value 173. We have a lower margin of safety because it is such a well-established and well-known company. So buy in around 120. It's been as low as 124 this year, as high as 198. Discounted cash flows is actually coming up with 261 because they are decent on their cash flow. Although I'd argue those cash flows aren't bringing a whole lot of value to the company. When you look down here, last year, $139, the dividend around $129, and the earnings $158. So $130 to $140 would definitely be a reasonable price for the stock. Earnings yield a little low, probably just because the price is so high, much higher than it should be. Cash flow yield, 28%. That is very high, incredibly high cash flow, higher than it has been traditionally. Dividend yield, 0.5%, down lower than it's typically been because the price is so high. Payout ratio, they definitely have room to grow that, although they don't seem to focus a whole lot on growing it. They seem to care more about buying back shares, which in the long term is bad for you as an investor if they're buying back these shares at $40 more than they're actually worth. So a 30% premium that they're paying for their own shares is just not an intelligent approach from the company's management. They have very good returns. ROE, 196, but that's because they have very, very high debt, almost a 6 debt to equity ratio. ROI almost 23%, ROA 28%. So they can fetch good returns on the money that they use. So a smaller dividend is definitely reasonable. Buybacks, probably too much. Gross profit of 43%, net profit of 25%, both over what they've historically been. So they are growing their margins. Revenues, really good historically. 3 and 2 year CAGRs look good, but analysts are not pricing much in going forward. They seem to think that this company has reached its peak, and 1.5% is underneath the target for inflation. So we'd be looking at a company on the decline at that point. They may be factoring in the loss of this revenue from the search engine and the competition that's emerging. And that may be why they're essentially expecting 0.5% decline of the revenues for this company. Earnings per share growth has looked pretty good again traditionally, expecting a dip this year and a small gain the following year. Cash flow growth looks really good. Their cash flows are incredible. Share count, they've been slowing down on their buybacks more recently, but they're buying back a whole lot. Assets are growing, not at a very fast rate. It's been picking up more recently. Liabilities have also been picking up more recently, growing almost 7 to 8% year over year. much faster than those assets. And that's going to, as we continue on, we're going to see how badly that hurts them, especially since how bad their balance sheet is in the first place. And then dividend growth, they're growing it around 5%. They've been slowing it down more recently, but that's because they're just raising it a fixed dollar amount. So earnings per share for the current value, we'd be looking for something like $9.14. Nowhere to be seen. That is way out in the future that they would be hitting that metric. Cash flow, we'd want $8.68 per share, so $138 billion in cash flow, and we see that their free cash flow this last year was $111. But with the expected declines in revenue, we'd expect a proportionate decline in the cash flows, and it drops down to just over 102.5 next year, and then moves back up a little bit the following year. So again, that looks like it's a few years out on the cash flows. A balance sheet, we'd be looking for $57 to $58 of net assets per share. So we'd be talking about $922 billion in net assets. And right now they are currently at $352 billion with $302 billion in liabilities. So 50.6. So the balance sheet is definitely the worst thing here. That debt is very, very high, especially if they're looking at declines or stagnation in those revenues. With the returns that they have, I don't blame them for high debt, but it is a very large number. I'm trying to look deeper into it to see what exactly is going on here with their debt and where all of this is coming from. We see liabilities. Current liabilities 153.9, non-current liabilities 148. So it's evenly split for the most part. Payables and accrued expenses are a large portion of their current liabilities. So they just owe people a lot of money. And for the non-current liabilities, they just have a huge amount of long-term debt. So hopefully that at least has a decent fixed interest rate. But out of these numbers here, we pull out this. So revenue, I'm saying 1% year over year going forward. I don't see them able to grow much beyond what they have. And we can adjust this to see how a higher number would affect all of this. Share count, the buyback 4%. That's more along the lines of what they've been doing recently. In fact, let's say they slow it down, only 3% with buybacks. Assets growing at 4%, liabilities growing at 8%, and the dividend growing at 5%, which actually is probably a bit generous, 4.5%. So in this scenario, what are we looking at for the fair value of the stock? Currently, it sits at 132. In 3 years, it would sit at 140. So if you bought at today's prices, you'd likely be losing $30 on the value of your holding, and you'd be looking at about a 23% loss. In 5 years, it'd be up to 151, $16 loss. You'd be down 13%. And I have down here what SPY would be gaining in the same time frame. So ideally, if you want to perform in line with the market, you're buying around 103. And for the 5 year, because of the slow growth, you'd actually have to buy it all the way down at 80 for it to compound to the point where you're getting 47% returns with the dividend factored in. So fair value of the stock, you're looking at a small profit, 19% over the course of 5 years, 8% over the course of 3 years. So you are much better off just buying SPY. And Apple is a holding within SPY. So you would get the same exposure, but there's nothing jumping out here that says that this is worth a buy. I mean, the cash flows and the returns look really good, but the revenue growth has not really been there. more recently, 2021, 2022, not a huge movement going forward. Nothing really expected there either. Net EBIT and gross, we do see an uptrend on those. Balance sheet, very flat on the assets. The liabilities are growing though. And we do have positive tangible assets and a positive tangible book value. Cash flows, we see some decent growth, but it's going to stall out this year if the revenues come in and they're able to get a near 30% cash flow yield, which is incredibly high. Dividend, they've been growing it consistently, nothing too crazy there. And then the actual evaluation price for the company. Balance sheet is awful, declining year over year. They are just not good at managing those liabilities, and they're outpacing the growth in assets, and it's causing a major decline on a balance sheet front. You're not owning much of the company. But everything else, cash flow has a nice uptrend, looking like in 2024, it's going to bring around $150 worth of value. The dividend, just a consistent upwards line, 140 in value. The actual fair value of the company being dragged way down by that balance sheet. I mean, we can't completely exclude that. It needs to have some sort of weighting. But 140 to 150 in 2024 is probably going to be what's fair for the company. And we, of course, would want to buy in something lower than that. So what are we seeing for the company? With the price being so high and the markets how they are, I would probably rate it a sell. In fact, I'm probably going to put it on the sell list. But what price should you pay if it's a company that you really want to own? It depends on the time frame that you're looking for. If you think that things are going to come in better here, let's say they come in with 2% revenue growth rather than 1%. And you're looking at 10% returns in 3 years buying at the fair value. What if they come in with what they have previously? Let's say 15% growth. Analysts are just, they don't see it. Apple's going to continue going how it's gone. At that point, you would be outperforming the market buying at the fair value. But if you buy at today's price, you'd be essentially breaking even. You'd be buying it at what the fair value would be in 3 years, which would be a massive premium on the stock. But over the course of 5 years, even growing at 15%, you're underperforming the market by 6%. So it's good on a 3-year basis, but the direction of the balance sheet is really hurting its growth ability because they might have strong cash flows, but when those debts come due, that's going to get eaten away pretty quick. And that's what we're seeing on the stock. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.